There were six key factors this week that are going to have an effect on Canadian housing. First off, we saw a major revision to the upside when it comes to GDP in Canada. Second, we saw inflation numbers in the US come out, and yes, even that ticked to the upside as well. We have learned a bit more about how Trump's potential tariffs are going to affect Canada and Canadian housing. Meanwhile, rental rates are definitely dropping and dropping basically in every major metro across Canada. National home sales information is in for the month of October. That might surprise a few. We'll dive into that. And lastly, there are going to be potential mortgage wars coming out, and maybe sooner than you may think. And this segment will be especially interesting if you have a mortgage that's renewing in the next couple of years or so. So make sure you stick around for that. Let's dive in to the first segment here, which is, of course, the revised GDP numbers that we have just heard about from StatsCan this week. They made a big revision to the upside. They essentially have found what equivalates to an entire year of economic activity hidden somewhere between 2021 and 2023, adding a total of 1.3% growth during that time frame. This is potentially great news for the economy, which is apparently performing better than previously reported, but could be considered bad news for the BOC, who just did their quote unquote jumbo rate cut based on data that wasn't quite equivalent to the data that we have today, right? Would they have done a jumbo 50-point rate cut had they had this new information that the economy is actually better off than expected? Maybe not. So you got to ask yourself, though, how this much growth was missed. I mean, it kind of does raise suspicions, right? I mean, especially at a time when Trudeau's position is clearly at risk. And, any good news for him, especially based on the economy, might help him, curb any resentment that he's currently facing. Now, outside of any tinfoil hat conspiracy theories here, which we could easily get into when you're seeing, StatsCan miss the number by that much. I mean, and it took them 3 years to find it. I don't know. Don't want to dive too much deeper here, but again, it does open up a bit of a can of worms. How much does this revision affect housing, right? What's going to happen with it? And I think, of course, the most immediate potential outcome here is they stop cutting rates, or at least for the short term. Why cut rates when the economy is strong, employment rate is flat? It does potentially move the needle here, or stop moving the needle when it comes to the December rate announcement. Still, even as of now, markets are pricing in about a 60% chance of a 50 basis point cut in December, whereas at least a 25 basis point cut in December looks to be a lock.
I don't know, Dan. I don't buy it. It's one thing for StatsCan to say, oh, hey, we missed 1.3%, which, by the way, like you mentioned, is a massive amount. So did you not press something on your calculator twice when you're supposed to? Like, that's a huge amount to go missing. And it doesn't correlate with what we're seeing out in the economy, right? It doesn't correlate with businesses that are struggling right now. It doesn't correlate with, a lot of the economic activity that you and I hear about from clients, from the people we work with, from industry professionals. It doesn't entirely line up. So again, I wouldn't be surprised if we continue down the rate cutting path we've seen. Is it political fodder? I don't know. But at the end of the day, one of the things we are really going to have to worry about is the potential of Trump tariffs, things that we're moving into now. So while it's too early to completely understand what he's going to do and to what degree Trump's tariffs will come to be, but let's figure that they're going to be somewhere between a 10 and 20% tariff on goods. If that actually gets realized, that would equate to around minus 0.5 to 2% in the lowering of our GDP. That would be disastrous for Canada. Whatever the number is, it's not good, right? So with businesses closing, productivity dropping, combined with negative population targets and now tariffs, this could be another painful blow to our economy. These measures would point to lower and lower interest rates, which from a housing perspective might be good if you're a buyer or a seller, and it would help arguably stimulate more housing construction. But here's where it gets a bit tricky. because Trump's vision of a prosperous country is being seen in the US 10-year bond yields. They're up 75 bips just this last month, surpassing 4.3%. Meanwhile, in Canada, we're looking at 3.1%, and this marks a 30-year low in terms of a comparative gap. So foreign capital will continue to be a problem for Canada because with the US at 4.3% and Canada at 3.1%, I can't imagine people, in foreign investment would want to come to Canada when there's clearly an alternative that's performing much better down south. Not to mention the capital gains increases that Trudeau has recently done. This may compound over time, pushing Canada into a very challenging economic position, where lower foreign investment coupled with these tariffs, declining productivity, and negative population growth will contribute to potentially stagnation or even a deeper recession, depending on whether or not we decide to change the GDP numbers. In this scenario, while lowering interest rates may boost housing activity and new construction, the broader economic impacts will likely be offsetting these benefits because there's fragile growth for the rest of Canada. And I mean, it's great if we can all of a sudden start building more homes, but only if people are going to be able to buy them on the other side. And if we find ourselves in a recession, well, you get the idea. As we move forward, it's critical for us to keep our eyes on how these factors continue to evolve and create strategies accordingly to safeguard our economy and ideally its stability. We should expect to see the Canadian dollar continue to weaken, not just over the next few months, but over the next few years, especially if we see these tariffs. And what's more is the US may very well see more economic growth, while Canada could potentially move in the opposite direction. So while Canada may want to drop rates further, the US may very well start holding. If the bond yields are any kind of indication of what's to come, that could be a very difficult position for the Canadian economy.
Feels like there's a lot of negative news out here lately, doesn't it, Ryan? There's becomes harder and harder to find the positive stories. This next segment, well, maybe it is a little bit positive, at least if you are a renter or considering being a renter, because one segment of the real estate world that is definitely dropping is, in fact, rental rates. Year over year, rental rates were the most pronounced in Vancouver at 8.5% and Toronto at over 9%. Where when we look nationally, we just saw the first year over year rental rate decrease hitting 1.2% lower. Keep in mind, it was as recent as just this past May, where that number was a 9.3 increase. So the rate of rental rates dropping is quite pronounced here. The shift in this metric is on the heels of record condo completions in Toronto, a reduction in the rate of population growth, and what I believe to be is people just simply being tapped out, right? If you have every element of life being more expensive, and with most renters on a fixed income, there is simply a maximum amount that can be spent on housing before other facets of life become too challenging, right? You have to eat, you have to travel to work, you have to have, let's say, your medical bills covered, right? And once that's all spent, you only have so much left for rent. And so that's by part of the reason I think we're starting to see this downward cycle in rental rates. So while rents have become slightly more affordable, they're still 29% higher than they were just 3 years ago. So if it doesn't feel like they're quite becoming affordable yet, yeah, you're not alone in that sentiment.
You know, it's funny, Dan. I was anyways at a builders event yesterday, and it was funny listening to a lot of builders and what they intend on building. And there seems to be two sort of big segments, and I'm not quite sure which one's bigger. It was, we need to build more homes, or we need to have more supply of homes available for families, while at the same time being able to have the right kinds of homes for people to downsize into. All the while, it left me thinking, well, if you're going to be selling your $3 or $4 million single family home and you're moving into a downsizing unit, we're actually preparing more for the baby boomer generation to retire than we are preparing for a younger generation to thrive. And that kind of got me worried about sort of how things were progressing, and a young family being able to afford a 3.5 or $4 million house. So it's all getting kind of wacky in my mind, and I'm not quite sure if a lot of these policies are geared towards making it affordable for younger generations to thrive, because if we don't have a strong future, then the way things currently are could get worse. Anyhow, like you said, it's kind of getting harder to find those good stories, but alas, I digress. Let's get into U.S. inflation. U.S. inflation rose 2.6% in October. That's up from the 2.4% in September, and higher than the 2.5% in August. And this is the first month-over-month increase that the U.S. has seen in the last 6 months. Though the 2.6% rate increase was actually what was expected, so it was in line, similar to Canada, similar to Canada in the sense that about 50% of that inflation number actually comes from shelter component. So this means the lower the rate, the lower the inflation prints could be, hypothetically, but these cuts will take time to take effect. We know that it's usually 6 quarters before that actual rate cut is felt in full, or rate hike is felt in full. So after the print, markets priced in a 66% chance that the Fed will cut at the December 18th meeting, and this is up from the 50% prior to. Donald Trump's victory has raised uncertainty about where inflation might be headed and how the Fed would act if it got reaccelerated. In many instances, I don't think Trump has much interest in paying off a lot of the U.S. debt. So I could see and believe that we could see higher inflation numbers, which would then push the value of assets up. We'll see. Trump has vowed to try and reduce inflation by combating energy prices, which, energy does touch a lot of the inflation ticket. So mostly by ramping up oil production and natural gas drilling, fracking. But economists have warned that some of his proposals, notably his plan to sustainably increase tariffs on imports, would worsen inflation if they become fully implemented. In the short term, we can expect a cut from both the BOC and the Fed in December. And this is going to be setting us up for a very interesting 2025 spring season when it comes to home sales, which, if anything, we're actually starting to see a spike already as a result of the last interest rate cut. So it'll be interesting to see how we move forward here.
Yeah, the dynamics that move housing volumes and sales and prices are really quite fascinating. And now we're going to see a whole different element from what happens with Trump in the States. But let's focus in on today, because we mentioned the spike in home sales that happened in Vancouver during the month of October on last week's episode. And now we've got some data from Toronto as well, and their numbers were even higher. They experienced a 14% increase in sales month over month, but 44% year over year. Interesting, Montreal saw the same annual increase in sales. Now, the most logical explanation for this spike comes from a bit of what we call pent-up demand, which is a thing. And of course, well-qualified buyers that have been given the all clear, if you will, from the Bank of Canada when it comes to forward guidance in further rate cuts. That guidance has pushed consumer confidence to a 30-month high, which is starting to translate into higher and higher real estate sales volumes. Early November sales in GVRD point to this month hitting upwards of 2,400, maybe 2,500 units. That'll be a 3-year high for the month of November and be about a 45% increase year over year. Really big number. This is for November. That'll be the second month in a row where we will have seen and realized a significant year over year increase. And December, we'll see. It might be slightly elevated as well. My guess is it will be at this point. But let's talk about spring, because spring will likely now show a 2-year high in sales, probably starting in February. I think we'll probably see an early spike compared to where we were the last couple of years. Now, one element that may boost spring sales even further is the potential return of the investor. The monthly condo cash flow index, which bottomed in late 2023, about a year ago, with the average condo losing about $600 per month after we include the principal pay down. That has bounced all the way back to basically parity, aka it's zero. It's flush right now. So if you buy a brand new condo, or the average condo with the average renter, with the average mortgage and the average mortgage rate, after you consider principal pay down, you're basically cash positive or cash neutral, excuse me. But let's be honest here. Yeah, you are still feeding it because you are paying that interest, right? So you're still feeding your condo about $700 a month. So it's not that attractive yet, but it's a trend that's important to watch, because that chart from that negative $600 a month has gone basically straight up ever since. And should condo prices continue to drop even further, it's going to take that $700 a month and make it much less. There will be what we call a tipping point, where you see that segment of the marketplace come back and buy condos en masse like they have historically, especially what I think will be the savvy investors who recognize the shortage of new condos that will happen around 2028, 2029. Prices will most likely increase during those years. And considering the discount that you can buy them at today, a 4 to 5 year turnaround, it's got potential, right? There's so many developers who have shelved their projects last year, the year before, this year. And what does that mean? That means when we look forward to when these things complete 5, 6, 7 years down the road, there's going to be very few completing, meaning a likely potential shortage of homes then. So, some investors think, okay, cool, I'm okay to spend $700 a month now to feed this thing that will likely see a relatively strong appreciation rate over the next 5, 6 years. This is not investment advice, of course, but hey, do reach out to us if you'd like to learn more about which areas have the most potential for these returns.
Yeah, it's like you said, it's a bunch of different dynamics taking place all at the same time. And to kind of add to that complexity, or something that I think investors or even first-time home buyers, or any home buyers for that matter, should watch, are the potential of escalating mortgage wars between the competition between banks. And this is a result of some recent policy decisions. So with approximately 50% of all Canadian mortgages renewing in the next 24 months, I think there's 1 million renewing next year alone. And with the new rules stating you don't have to requalify now to switch lenders to obtain a better rate, it's highly expected that you're going to start to see banks going to war with each other to grab this business. So there is an immense amount of business that's up for grabs, especially over the next 2 years, and homeowners should become more savvy about what's available to them. So knowing that you can shop your mortgage now and looking at that all-important monthly payment, make sure you're going to multiple different sources to find out and get them to compete for your business. It's in your best interest to put in the work and let the lenders compete for you. You may very well save yourself tens of thousands of dollars, or at the very least be paying a whole lot more principal than you would be interest.
Yeah, definitely worth doing. And it's true. Banks want business, and they've had a couple of slow years here. So they're going to do everything they can, use every trick in the book to get your business. And ultimately, when it comes down to it, everybody just wants the best rate. So I expect to see some pretty good quote unquote deals comparatively in the marketplace over the next 2 years. So definitely shop if your rate is coming up, and you want to start shopping your new rate about 6 months prior to renewal. So that if that's you, then go have a look or reach out to us. We can definitely recommend the brokers and lenders that we work with and favor the most. Okay, now the big important question. Looking forward here, Ryan. We're actually recording this on Friday. We normally record this on Thursdays, but it's Friday because I'm kind of sick if you can't hear it in my voice. But by the time you watch this, it will have already happened. But I think we should put in our guesses here, Ryan. Tyson or Paul?
Oh, well, I mean, I'm a big Mike Tyson fan. I think Iron Mike will have a level of technique that'll be hard to overcome. Plus, if he finds his ferocious self in the ring, that'll be a huge surprise to someone like Jake Paul. However, I think if Mike doesn't knock him out in 3 or 4 rounds, then it could be become a little bit more problematic. But I think Tyson's going to go for that knockout, and I think he's going to go for it pretty quick.
Nice. Yeah, I'm of the Tyson era as well. I'm definitely a fan, was always a fan back in the day and watched every one of his fights. From being a fan, markets, if we will, are pricing in a Jake Paul win. Most of the bets are on him. Not too surprising. That's not a cop-out. I'll definitely put my hat in the ring and say, yeah, I'm going for Mike Tyson in the third round with a knockout.
Hey,
there it is.
If he's got his old gloves with him, I mean, it's very possible. But who knows if this has been scripted? I guess we'll find out.
Ultimately, they're both coming out pretty wealthy, so it's a win for both.
Yeah, totally.
And nice to see Mike making tens of millions of dollars, in his 50s in the ring. That's fantastic from that element. Okay, well, thank you as always for tuning in and watching. That's what's important this week in Canadian housing. We will be here next week with what has moved during those days and update you on what's important next week. And have a wonderful weekend. We'll see you here then.